Good afternoon and welcome to our first Academy Forum of 2025. 2025 is the year that HWB are celebrating our 40th anniversary, actually in July, hence the new logo that you see on that first slide there. So I'm Michaela Johns, one of the directors at Hopper Williams & Bell, and I head up the Academy's school team, and I will introduce you to my colleagues in a moment. So, like many of you, we're all waiting eagerly to hear more announcements for the sector in the spring statement, which was due on the 26th of March. But there is some press notes saying that this might be pushed back to June. So watch this space. The critical announcement for all of you in this is if the NIC increase is going to be fully funded or only partially funded, or indeed if the government is going to backtrack on this initiative totally for everyone, not just even academy schools. So let's all wait and see, and we'll deal with it then. But just a little note for you, just in case you haven't worked it out yet, the extra cost of a person earning an average salary of £37,000 per annum to you as an academy school is £950 in national insurance. So I'll leave each of you to do the figures to see what effect that could have on your trust if it is not fully funded. So just some practical points before we start the seminar. Please do put any questions you have in the chat box and we will answer them as we progress or at the end of the session. Your cameras and microphones are switched off unless you are presenting today, and the presenters will switch on their cameras as we speak. We will send you the slides and all the documents that we refer to in the follow-up email at the end of the week. So you can then share these with your colleagues and trustees if you want. The webinar is also being recorded and will be available then on YouTube. Again, we will send you the link. There are some interactive polls, so we can share the results with you. If we could just call up slide 2, there we go. There's a QR code there that you can scan in to your phone or onto your laptops, and therefore you should then be able to participate live with those polls as we proceed. It is totally anonymous, so please don't be worried about that. So onto the agenda slide then. This is what we're going to cover today. So the first topic, matters arising from the audit findings. Alan Davies will cover these points. Then we will move on to Gary, who will cover best practice for you, preparing your management accounts. Then James Flood will touch upon integrated curriculum financial planning. And then we'll go back to Alan Davies to cover the benchmarking highlights. Each of you that are clients of HWB will have received your own personal report, unless you're a college or a special school, and therefore it might be useful to refer to those. Then we will move on to Alan Rolfe, who will look at tax efficient benefits for you and your teams, and then go on to do a brief VAT update. Alan Davies will then remind us of the changes that have coming into effect on leases, and then Matt Cooper will run through with you what to look at in terms of your investments. And then finally, I will remind you of the procurement limits and run over the timetable and deadline dates with you so that you don't miss anything crucial in the next year. So let's begin with the next slide with Alan Davies.
Thanks, Michaela. Good afternoon, everyone. It's February, we submitted our last accounts return, and we've reached the time of year where we can take a breath and reflect on last year's audits, at least before we start planning all over again for this year. So, as we usually do at our February forum, we'd like to summarise some key points which arose from the audits we carried out last autumn. I'll start with an overview, which was that most of our audits had clean, unqualified audit reports and regularity reports. However, we did have 2 instances where we did have to make a qualification. One of these related to our audit report on the financial statements, and the other related to the regularity report. The regularity issue was due to an unapproved finance lease. I won't dwell on this now because we're going to provide an update on this area a little bit later on. Our audit report qualification related to land and buildings. We also had a few other issues in this area, so I thought it would be useful just to give a summary. Under the accounts direction, even though a lot of academies occupy land and buildings under long-term leases, they are required to include a figure on the balance sheet to represent their right of use. This requires an academy trust to make a valuation of each property it occupies. Unlike some other types of property, schools are very hard to value because of course they aren't typically bought or sold, and there isn't an active market as there is for normal commercial property. Because of this limitation, accounting standards require academies to use a valuation method called depreciated replacement cost. This estimates the current cost of replacing an asset with its modern equivalent and makes a deduction for any deterioration in its physical condition. The accounts direction gives a summary of possible options an academy can use to value its land and buildings. Newly constructed buildings are straightforward to value, as it's usually easy to quantify the construction costs. However, the point that the buildings are recognised is not always clear. This year, one trust had buildings constructed on-site by the local authority. In this situation, the accounts direction states that the buildings are only recognised once complete and handed over to the trust. This is very different to the treatment required if the buildings are constructed with a capital grant paid directly to the academy by the DF as assets under construction as it builds up. Pre-existing buildings pose more of a challenge, and the accounts direction gives three main options. Firstly, obtaining a valuation from a chartered surveyor. Secondly, using an existing local authority valuation. Or finally, using the desktop valuations which are provided by the DFE, although the accounts direction goes on to qualify this by stating that they may not be suitable, being desktop valuations prepared at a very high level. While there are several options, there are also some potential problems. Some trusts are understandably unwilling to pay for a professional valuation from budgets which could otherwise be used for education, and in many cases, local authority valuations are not available, although we did see one instance this year when they were used. Although DFE desktop valuations are prepared for all academies, for new converters there may be a delay between the preparation of the accounts and the receipt of the valuation report, and our qualification arose from this issue. The trust concerned didn't have any valuations for two of its newly converted academies. Local authority valuations were unavailable, the DFE ones had not yet been received, and it was unlikely that professional valuations could be prepared in time, even if the cost could be justified. The trust therefore had to prepare its financial statements to omit the value of the land and buildings in respect of the newly converted academies. Because this was a material departure from the accounting standard, we were required to qualify our audit report, although the accounts did give full disclosure of the circumstances of the issue. In another case, a trust did commission a valuation report from a qualified chartered surveyor, but the report was prepared on a market cost basis rather than using the depreciated replacement cost method, even though there was very little market-based evidence available. The valuation was therefore unsuitable for inclusion in the accounts, and an alternative method was used, as details of the original construction cost were available. In summary on this point, we recommend that multi-academy trusts review the position of any newly converted academies as soon as possible, and if you do commission a valuation, ensure it will use the depreciated replacement cost method. And please do get in touch if you have any specific questions in this area. Moving on, but staying with a similar topic, church academies typically occupy land and buildings under a license rather than a long-term lease. The accounts direction requires church academies to conclude whether they have control over access to the buildings, and over any construction works. As a result, this becomes a very judgmental area where, in practice, we see a lot of variation in the accounting treatments adopted in the sector. In some cases, no value is included on the balance sheet because the standard wording for a license specifies that control is not given. However, some trusts do recognise a value because in practice, the trust often has full control. An area that is sometimes missed is that while the main school buildings are occupied under a licence, the school playing fields are often leased from the local authority under a separate arrangement. As we've seen, the Accounts Direction requires leased land and buildings to be included on the balance sheet. In one case last year, a trust had to make a significant adjustment to bring in the value of the playing fields, which had previously been omitted. So that's just something to watch out for if it's relevant for your trust. So we're thankfully now leaving land and buildings, but I'm afraid it's out of the frying pan and into the fire, as the next issue relates to pensions, which is another area where the required accounting is often confusing and counterintuitive, particularly to governors and trustees. Last year, most of our trusts saw their share of the local government pension scheme move into a surplus position. This was because the returns on assets were higher than the scheme actuaries had anticipated the year before. While trusts were familiar with the concept of recognising a liability on their balance sheet, a surplus in the pension scheme requires us to consider whether it's correct to recognise an asset. The accounting standard states that a pension asset is recognised only to the extent that an academy can recover the surplus, for example, by making reduced contributions in the future. As the fluctuations in assumptions were projected to be relatively short-term, we didn't anticipate that there would be a reduction in the contribution rate, and therefore we recommended recognising a zero balance rather than a pension scheme asset. And just to conclude on that point, it's worth noting that the figures have no bearing on the future LGPS contribution rates, and they're just purely for accounting purposes at the year end. I'll just briefly mention related parties and, in particular, conflicts of interest. While we didn't have any significant issues in this area, it is one where we do receive queries occasionally, so I thought I would mention a useful document published by the Charity Commission, which has guidance on identifying and managing conflicts of interest, including suggested steps for a trust to consider when deciding on the best course of action to prevent a problem arising. We'll circulate the link after the meeting, but you can find it by searching for Conflicts of Interest, a guide for charity trustees. I'll now move on to the next slide and provide some feedback from our audit findings reports. Generally, we've seen a reduction in the number of issues raised, both for financial statement and for regularity issues. And, as you can see from the slide, a lot of the issues that we did raise were low risk. I'm therefore going to concentrate on the medium and high risk areas, in particular high risk, as the number of those points forms part of the annual reporting to the ESFA. In some cases, we raised issues relating to the management accounts and procurement, and I won't dwell on those because we're going to cover those topics separately later in our presentation. Additionally, we noticed issues relating to information held online, both on the Academy's own website and on external websites, such as Companies House or the DfE's Get Information About Schools. Our recommendation is to review the requirements set out in the Academy Trust Handbook and build a monthly check into your procedures to ensure that the published information is up to date and consistent across the different websites. Other areas where we noted issues related to reconciliations of key balance sheet control accounts, such as bank reconciliations, accruals, prepayments, and fixed assets. And our recommendation here is to ensure that the key balance sheet accounts are reconciled each month, that all balances agree to supporting schedules, and that each reconciliation is reviewed to ensure that it has been prepared correctly. Similarly, we noted some cases where the monthly payroll reports had not been reviewed and authorised prior to payment. So our recommendation is to ensure that this control is in place and that the review is clearly documented and dated. Finally, we noted a high-risk issue in relation to the level of reserves held. While many academies are good at monitoring their reserves, large construction projects can make it much harder to do this due to the significant levels of additional income and expenditure. We saw one instance where the school's contribution towards the cost of a large capital project had not been adequately budgeted, resulting in the academy carrying forward a deficit on its general funds. Additionally, we noted one instance where a Salix energy efficiency loan provided as part of a capital project had been incorrectly treated as a capital grant, requiring a reclassification in the accounts. We recommend that capital projects are reviewed to clearly identify the amount of any school contributions that are required and any element that relates to Salix loans. I hope that gives a useful summary of our findings. I'll now hand over to Gary.
Thank you very much, Alan, and good afternoon, everybody. Alan touched on it briefly there, but some of the themes that came out of our year-end work related to management accounts. There's also been a fairly recent good practice guide update published in October 2024. So we thought it was a good opportune time really just to go sort of touch back on management accounts, looking at sort of format wise, what's included, steps to take, etc. It's also been quite a common theme from the ICFP reports for the last couple of years. So looking back to 2023, they've often shown to internal financial reporting to be the #1 theme that gets reported by auditors. And within internal financial reporting, management accounts makes up about 2/3 of that 1/3. So it's quite a hot topic, and you can see why they've refreshed their good practice guide. Typical issues that we see and have been reported by the ICFP is management accounts not being produced, not being shared, missing components of the management accounts, and just timeliness issues as well that they're experiencing. So we can see why they've published it and just done a reminder. So we included a link there. So if you go to that link and the landing page takes you to the good practice guide, there is also they've included a management accounts or suggested management accounts layout as part of the good practice guide. That's on the landing page as well. It's an Excel document. It's not overly complex. The format might be familiar to you, but it might just be worth having a review of that layout just to make sure that you are there's anything that you can pull from that layout which might be useful in your own management accounts. Like I say, it's not overly complex. It includes recurrent income and expenditure variances, capital variances, a balance sheet, a rolling cash flow forecast, a split of age debtors and split of age creditors. So nothing overly complex there, but it might just be worth having a look at it. It's not a requirement to use it as well. So if you've got your own template, then carry on using that, but just pull anything from there which you just find particularly useful. So why we've got to prepare management accounts? Well, one, it's in the ATH, so it's a must in the ATH, so it is a requirement of all academy trusts, but also it's really there to facilitate your trustees as well. So they've got a responsibility to have robust oversight. It mentions it in 2.1 of the ATH that they must do that, but also as trustees they need to discharge their responsibilities over governance. So I think it would be hard pressed for a trustee to argue that if they didn't have sight of those management accounts they could do that. So it's a real important requirement of the Academy Trust Handbook. So what must be included? So the Academy Trust Handbook stipulates what has to be in there. So an income and expenditure statement, variances to budget for that income and expenditure statement, cash flow forecasts, which are a rolling 12 months. So if your cash flow forecasts are just for 1 or 2 months, then really you need to sort of focus on that area. A balance sheet. So often we would, a few years ago, a lot of our reports said, sort of commented that balance sheets weren't included as part of the management accounts. So a lot of that's been brought up to date, but balance sheet is a requirement. KPIs aren't a requirement. They disappeared from the ATH back in 2022, but our recommendation would really still be to include those. We just find they're a really useful tool, and I think they can really sort of help to highlight some areas of the management accounts which really need some focus, and hopefully trustees find them useful as well. So steps to take. So Alan mentioned earlier in his slides about us picking up key controls which haven't been reconciled. So the first real key step to take really is to make sure those control accounts are reconciled, and this doesn't just include bank accounts. It includes payroll, net wages, any charge cards or any credit card control accounts. Often we will see liability control accounts in a debit position, which can quite clearly indicate that there must be some missing costs from those accounts. So if you can get those control accounts reconciled on a monthly basis, you're 90% of the way there. So please do focus on those areas. Include things like pension accounts as well. So often we see pension accounts not fully reconciled. Preparing payments and accruals. So really here, you could go on and on with preparing for payments and accruals. So really setting a de minimis as to what the trustees would be happy with and what management would be happy with within the trust, because you don't want to be sort of prepaying something which is £50 over a period of 12 months. There's just no benefit to the trust to do that. However, you do want to make sure that this is done on a monthly basis. Often we'll see prepayments and accruals just done at year end, so you tend to get some quite spiky months. So it's really key to make sure these are done on a monthly basis. A question we often get is, well, do we need to prepay costs where the actual prepayment lapses within the year? So perhaps it's for 6 months and it runs from March through to August. Well, actually, in that circumstance, yes, you still do. Otherwise, you're going to get those spiky costs. So we would still recommend that that you do that. Creditors and debtors. So we often find that these don't agree back to the trial balance. So often within accounting systems, it's possible to post directly into the trial balance ledger and not through the actual creditors and debtors ledger. So when we're running reports, often these don't agree back to the trial balance. So just doing a monthly check to make sure that these creditors and debtors balances do actually agree back to the trial balance, I think it is very important. Fixed asset movements, depreciation, additions of any fixed assets, any disposals. Again, this is something we often see which is not done until year end. Again, a question does often come up on this as to whether that needs to be on the balance sheet. Strictly, yes, it does need to be on the balance sheet because that is where these capital items are going to end up. However, we do understand that trustees sometimes do like to see these going through the income and expenditure. In that case, we would just recommend that if that's what the trustees like, then a note is just put on those accounts just to make it clear that they will be reallocated as part of year end, because that can often cause some confusion. It's not in the good practice guide, but we would very much recommend that a checklist is used, primarily to make sure that all the control accounts and steps that are taken have been taken before the management accounts are issued. We also see it as being a good tool really in case anybody's off ill or someone else needs to step in really just to complete those management accounts. So we do have a checklist internally. So if anybody would like to see or have a copy of that checklist, then please do ask. So the good practice guide doesn't stipulate certain things within it, although it does recommend certain things. So there is some discretion on what you can do. Income and expenditure variance commentary, I think, is key, because without this, I'm not sure that the trustees can really understand or have oversight of what's gone into each income and expenditure code. You may want to agree on thresholds with your trustees, because what you don't want to be doing is adding commentary where it's not really important to the trust, or a risk to the trust. So really establishing what's important to the trust, and making sure the commentary is centered around that. Maybe linking the commentary as well to the trust's own risk register. If there's risk that the trust has identified, then really the commentary needs to be reporting on that. If there's any sort of feedback into that, then I think that would be very useful to trustees, just to have that link. One area which is missed as well is where perhaps certain judgments or uncertainties are built into those management accounts. So often we just assume that the person reading it knows what we've assumed or what judgments we've made. So if there is anything that you've had to make a judgment call on, then we would very much recommend that is included. If there's some missing costs, which you've had to make an estimate of those missing costs without a lot of support, I think that's very useful for the trustees to know that that's what you've actually done. And don't forget the balance sheet as well. So often there's variances or variance reporting commentary around income and expenditure, but often we don't see much around the balance sheet. The template, the layout, which I mentioned earlier, doesn't include any variances around the balance sheet, but I think it's equally as important to identify if there's big movements in creditors or debtors. You could have some quite big swings in deferred income or accrued income on a monthly basis, particularly where you're undertaking a large capital project. So don't forget the commentary around the balance sheet as well. The good practice guide also does stipulate that the debtors should be split out between the trade debtors, so any monies owed for higher income, etc., those sort of things which have not been paid to date. So just so the trustees can have oversight of any potential bad debts which the trust may be facing. Hopefully these are few and far between. But also I think it's important to be able to analyse and split out creditors and accruals. So if there's just one line for creditors and accruals, it doesn't lend itself to understanding what estimates the trust has made in terms of any accruals. So I think splitting out trade creditors and accruals is very important. So the more analysis you can give the better. The last two areas of the good practice guide focus around cash flow. They do include a rolling cash flow within the template. I think it's key that this is done. So once 1 month drops out, you then add on a further month. That's the idea behind a rolling 12-month cash flow. One of the responsibilities of the trustees is to ensure that the trust is going to be a going concern for a 12-month period from any date, really. So being able to see this cash flow and see any pain points, I think is key. So if your current management accounts don't include a 12-month rolling cash flow, we'd very much recommend that they do so. And I mentioned earlier about KPIs dropping out in 2022 from the mandatory requirement. We still see this as an effective tool. Firstly, because it can identify potentially any errors or help the accounts, the finance team to identify any errors. Perhaps you might have an error in net wages, or the KPI, the staff pay versus expenditure may be looking odd. That might indicate an error in net wages, which perhaps you'd not spotted previously. So having those KPIs, I think, can be very useful. And finally, don't forget KPIs around the balance sheet as well, because they're equally as important. One KPI that I always focus on is the current ratio. So how much your debtors versus your creditors. So can you pay your creditors as they fall due? I think that's a very good KPI to help trustees sort of understand the liquidity of the trust. We do have a fact sheet on KPIs, so if anybody's interested in seeing that KPIs fact sheet, we can send that through to them. Okay, that's just a quick tour of the management accounts. If anyone's got any questions, to post them in chat. That's all for me, so I'll hand you over to James Flood, who'll be looking at integrated curriculum financial planning.
Thank you, Gary, and good afternoon, everyone. Just a quick one from me today, covering, as Gary mentioned, integrated curriculum financial planning. It is a bit of a tongue twister, so I'll use the ICFP abbreviation from here on in. So the DfE has recently updated its guidance page on the gov.uk website on this. So it has prompted us to provide a quick reminder really as to the primary purpose of this type of planning and the potential benefits that it can bring. I will also be attempting to do a quick poll at the end of this section, as I'm interested to see how many of your schools have used and explored ICFP previously. So the changes that I mentioned published by the DfE recently have been predominantly to provide more detailed guidance and to update the tools available, and in particular the primary and secondary schools workbooks to make them more accessible and usable. So for those of you who are less familiar with ICFP, it is a financial planning process that helps schools plan the best curriculum for the pupils with the funding that you have available, and it can be used for any type of school. It is also commonly used by SRMAs as part of their reviews when they're instructed to work with academies that are perhaps in less fortunate financial positions. The process itself involves measuring your current curriculum, your staffing structure and finances, and then using this data to create a 3 to 5 year plan. The idea of linking curriculum and financial planning isn't a new one, of course, and all of your schools are likely to already be doing some form of ICFP, perhaps without even realising it. Because it takes into account things such as benchmarking and key performance data. So things including staffing cost to income ratios, overheads analysis, and most other metrics that you'd probably consider to be an academy KPI. The ultimate aim from using ICFP is to deliver the best curriculum that your school can afford ultimately, and that obviously meets the needs of the pupils too. The most common steps to ICFP are firstly to get curriculum and financial planners, whether that be your finance team or external experts, to assess your school's current financial situation and teaching resources, and then to establish common assumptions about what will change over the next 3 to 5 years. So things such as pupil numbers, funding, cost, staffing, educational policy. So all in all, there are a lot of similarities between this process and putting together your budget forecast returns. And so ICFP really can be used as an extension to this. So you can then plug the results of your findings and your assumptions into the financial planning tools available, which are on the DfE or gov.uk website, to produce different metrics. So things such as pupil teacher ratios, average class size ratios, costs per lesson, and many others. And then this analysis will then allow you to assess the number of teachers that the school can afford and the number of teachers needed to deliver your ideal curriculum. If there are any large variances in these metrics and benchmarking information, then these will need to be investigated and reconciled in coming up with your plans. So on the gov.uk website I mentioned, there is a very basic free ICFP tool, which pulls information out of your recent financial statements. And it will show you an overview of your school statistic versus others around the country. So I certainly recommend having a look at that. There are also some useful courses available hosted by the likes of the ISBL, which it might be useful for the business managers amongst you to attend. I do think ICFP is an area that the SFA will continue to try and push, particularly where reserves are getting tighter and with falling birth rates in certain areas creating future uncertainty. So as I said, just a quick one from me on ICFP really, but before I pass you over to Alan to go through our own benchmarking findings, as I mentioned before, I would like to do a quick poll really to gauge how many of you have considered and used ICFP specifically as part of your budgeting and future planning. And depending on the outcome of this poll, it might be something that we delve a bit deeper into in future sessions. So if you could use the Slido app to participate in this poll for us, that would be much appreciated. I'll give you a minute or so just to log in and answer that one. Brilliant. Okay, I think a few answers still coming in, but a real mix really. So that is interesting. I do wonder whether it's something that will continue to be pushed and pull to the front of the ESFA guidance moving forwards. Yeah, so thank you for that. So yeah, I shall now pass you over back to Alan, who will be going through some of the trends from our own benchmarking findings with you.
Thanks very much, James. As Michaela mentioned at the beginning, we use information from our accounts returns to produce a free of charge benchmarking report for all of our academies, and we issued this year's reports at the end of January. Our ethos, if you like, in preparing the reports has always been to keep the report to a relatively small number of key performance indicators, or KPIs, which are comparable between trusts. Looking at lots of statistics can sometimes be misleading, such as in some cases, for example, premises costs such as cleaning, which can vary from trust to trust depending on whether it's carried out in-house by the academy's own staff or outsourced to a contractor. So things aren't always comparable. We aim to issue our reports as soon as possible so that it can be used promptly. We keep it to a one-page summary and we ensure that it's comparable from one year to the next. We also include a summary which shows how the number of audit findings reports points compares to the average number for other trusts in the same phase. This year, we made one change to our report to add an additional KPI to measure investment income. We'll discuss this area in a little bit more detail later on with Matt. We've also prepared a short summary of the key figures from our benchmarking, which we'll send out after the presentation. And that shows the average figures for primary phase and secondary phase. So just a few highlights from this year's edition. We did see increases in funding both for grant and non-grant income. At primary level, income measured per pupil increased by 5%, and at secondary level the increase was 9%. However, at both primary and secondary level, expenditure per pupil increased at a higher percentage, being 7% and 12% respectively, so there's quite a swing there. Looking at expenditure specifically, the key expenses were generally in line with the previous year as a percentage of the total expenditure, with most of the KPIs being within usually 1 or 2 percentage points of the previous year's figure. Expenditure on staff costs as a percentage of the total costs is a key statistic for many trusts, and in 2024 this was 78% at both primary and secondary levels, which was very similar to the prior year. And non-staff costs as a percentage of the total costs were also broadly in line with what we saw in 2023. In recent years, we've seen a trend of an increasing number of academies making in-year surpluses, I think over the last couple of years certainly, and that's after excluding fixed asset additions and pension funds. However, unfortunately, last year we saw that trend halted and slightly reversed, and we saw over half of our trusts record a in-year deficit. Consequently, the average financial position has deteriorated slightly from the previous year, with the level of reserves held falling at both primary and secondary levels, and taking the level of reserves as a percentage of the annual income, we saw on average a fall from 16% in the previous year down to 13% in the current year. So Academy Trusts are having to dip into their reserves to keep up the required level of expenditure. Finally, as part of our information, we look and see who's using the ESFA chart of accounts. And this year we've seen again another increase in the number of academies using that chart. So just over half of all of the academies that we act for had adopted the new chart in the last financial year. And if you have any questions on the chart of accounts to do with mapping your old chart, if you're considering a change, for example, or any logistics such as timing of the change, please do get in touch and we'd be very pleased to help. So I hope that's a useful summary. Let me know if you've got any questions, and I'll now pass over to the other Alan.
Thank you, Alan, and good afternoon, everyone. I'd just like to touch on some tax points just as a good reminder of ways that you might be able to help staff to benefit from benefits that are perhaps not always looked at as a standard part of the remuneration package. These can help retain and motivate staff, but also it might save the Academy Trust some cash as well, particularly where there's some national insurance to be saved. So there are benefits all round. The first point really that I want to touch on is that there's been specific comment in the Academy Trust handbook that now requires trusts to get prior permission from the ESFA if you're going to offer electric vehicles, typically via a salary sacrifice arrangement. From a tax perspective, offering an electric car as a benefit in kind through a salary sacrifice can be very efficient because it doesn't cost the Academy Trust anything extra because of the salary sacrifice, but the member of staff will benefit from a very low benefit in kind charge, currently only 2% of the list price of the car. So, for example, if we're talking about a £40,000 car, the benefit in kind is only £800, and obviously the tax on that is even smaller still, perhaps only a couple of £100. So they're very, very cheap way to have an electric car. But obviously the ESFA are struggling to see that as normal, and perhaps they're concerned about trusts signing up for electric vehicles, but it is a very efficient way of providing a benefit in kind to staff, and obviously it's part of the green agenda anyway. So I just thought it was useful to sort of touch on that point about the fact that the ESFA is a little bit behind the curve on that and require permission if you're going to offer electric vehicles to staff, either anybody new joining the scheme or if you're setting up a new scheme. There are a few other opportunities to provide tax efficient benefits. One of them, which is quite useful for ad hoc gifts, is the trivial benefits exemption. You're probably all aware of this. It allows up to £50 to be provided as a benefit in kind, but it can't be in cash. It can be something like chocolates, flowers, but it can also be gift vouchers. So it's quite a good way to reward someone, perhaps for a birthday, perhaps for successful Ofsted, whatever. It mustn't be a direct reward for services, though. That's the one thing just to watch out for. So it needs to be not in return for a core part of somebody's work, but it can be for other reasons. So lots of different reasons. Cycle to work schemes are useful. Again, this can be salary sacrifice, so it doesn't cost the trust any extra. And the provision of a cycle to someone will be a tax-free award, so they can get a bicycle for nothing essentially, or at least via a salary sacrifice if the trust doesn't want to incur any cost. That's a lot cheaper than the person buying the cycle themselves. There might be a small exit charge when they leave the when they retain ownership of the bicycle later down the line, but that's typically very, very small sum. And overall, they'll always save money through that route, even through a salary sacrifice. Some staff may occasionally struggle financially, and so loans are possible. You can loan up to £10,000 without a benefit in kind arising for a member of staff. That could be quite an incentive perhaps for new staff that maybe are trying to sort out accommodation, moving to your school or something like that. So occasional loans might be something you wish to consider. Long service awards are something that are quite useful for rewarding long-serving staff. The conditions for that are the person must have undertaken 20 years service, and that could be across a 2P situation. So I think we would be able to count prior local authority years if they were still at the same school throughout. And that can be up to £50 a year. So in other words, having done 20 years, you would get £1,000. It can't be given in cash, but obviously you can give someone the opportunity to have perhaps a holiday or set of golf clubs, whatever they fancy. Suggestion schemes can be a useful way of helping the Academy Trust. And you can also offer people small cash rewards for participating. So up to £25 can be given for participating in a suggestion scheme. And obviously the aim is to try and improve the trust, academic, but also perhaps financial performance. And where there's some financial savings, it's actually possible to offer a larger reward, which would be a percentage of the saving for the Academy Trust, up to a maximum of £5,000. So again, this is kind of showing everybody's working towards the same goals, and can be quite a useful opportunity with the member of staff not having any tax charge on that. And finally, back to the topic of electric cars. If you set up an electric charger at the Academy Trust, then anybody can use that without incurring a benefit in kind, whether or not it's a car owned by the trust or their own car. So that's quite an efficient way of offering people a small benefit and a nudge towards electric vehicles. I think the next step now is to have a quick Slido check on who's actually approached the ESFA to provide electric vehicles. I wonder if any of you have done so. Perhaps if you wouldn't mind having a quick go at this one, we can find out where the current land lies. Great. Well, thank you for that. It looks like a few of you have done so. So it'll be interesting when we next meet in person to discuss how that might look at, how that process has worked, and also perhaps as a way of looking for the opportunity for the rest of you. So thank you for that. I'd like to now move on just to a brief VAT update. Obviously, a lot of the talk has been about the changes for private schools, which don't really concern you, but that's obviously a headache for another part of the education sector. We haven't really had many other major changes to the VAT rules. The registration threshold was put up to 90,000 last April, which may have helped one or two Academy trusts avoid the need to compulsory register if they didn't wish to. But other than that, a relatively quiet time, except that we have had some sort of rumblings that the revenue may have want to consider whether the VAT favourable treatment for closely related supplies and for non-business activities should be disturbed. I'm not sure that there's any official policy change. There's certainly been no updated guidance issued on this, but it would be interesting if any of you come across a situation where perhaps the revenue argues something like a school trip or an after-school club is not considered closely related to the non-business delivery of education. That would definitely be something I'd be happy to support you on and fight the revenue over, because this is not an area of creep for the VAT law that we wish to see the revenue take. Similarly, for non-business activities, things like summer clubs, extracurricular things like the DFE, those are generally regarded as non-business. And this is something that, again, we don't wish to see the revenue eating away at and trying to charge VAT on or prevent the recovery of VAT on costs relating to these, because obviously these are part of what the school's community activities are often based on. So I think if you do come across any of this, please don't hesitate to get in touch, and we will, so obviously share any knowledge we get about any change of the revenue's view or interpretation. As of now, there's nothing official, but just it's something to be aware of, and I'd be grateful if you'd let me know if you come across any problems in this area. So that's really the quick flip through VAT. Nothing too much to report at this time. So perhaps I can now pass back to Alan Davies to talk a bit further about some leasing options.
Thanks very much, Alan. We've seen some changes in the requirements in relation to leases over the last year, but it's good news and bad news, I'm afraid, as although there are some simplifications to the approval process, the accounting is getting more complicated. By way of background, leases are classified into two different types for accounting purposes. Firstly, finance leases usually run for the majority of the leased equipment's useful working life, whereas operating leases are generally for a shorter period. For academy trusts, we typically see photocopiers and minibuses classified as operating leases, as the lease is generally for a short part of the equipment's useful life. However, shorter life assets such as computers or IT systems are sometimes required to be treated as finance leases. This is because the lease term is often for the majority of the useful life, and therefore quite similar to actually owning the asset rather than just leasing it. Operating lease rentals are shown within expenditure. It's quite a straightforward treatment, but because equipment held under a finance lease is in practice quite similar to ownership, the accounting treatment is a lot more complicated. In this case, the treatment is to show the asset on the balance sheet and record a matching liability for the future rentals that are still to be paid. And by recording a liability, an academy trust was essentially taking out borrowing, which required advance approval from the ESFA. Additionally, sometimes it was hard for academies to identify finance leases, particularly when a lease was embedded into a different type of agreement, such as a catering contract. As a result, we occasionally had to qualify our regularity report when the required ESFA approval had not been sought. Some forthcoming changes in accounting standards prompted the DFE to amend the approval process. For financial years ending 31st of August 27, the accounting standard will require the majority of leased assets to be shown on the balance sheet. There are two exemptions to this. Firstly, short-term leases, which are a year or less, and secondly, for low-value assets. Unhelpfully, the accounting standard doesn't give a huge amount of guidance as to what constitutes a low-value asset, but it does give some exceptions of items which are definitely not. And included in that list for items which are relevant to academy trusts are motor vehicles and land and buildings. It is possible that some other items typically leased by academies, such as photocopiers, can be treated as low value and a simpler accounting treatment adopted. However, for some assets, such as minibuses and short-term leases of land and buildings, an academy trust will need to record a fixed asset on its balance sheet to represent its right of use, and a matching liability representing the remaining lease rentals still to be paid. This will require academies to make a calculation of the discounted net present value of the future rentals payable under the lease, and it's discounted to take account of the time value of money. So this is a lot more complicated. But on the good side, the impending change prompted the DfE to provide a general consent to a wide variety of leased assets, including IT, telephony, catering and cleaning equipment, furniture, gym, groundskeeping equipment, LED lighting systems, minibuses and temporary structures. This consent applied from the 1st of April 24 and covered new leases and all pre-existing leases of the same types of equipment. While this was very helpful, the Academy Trust Handbook was only updated from the 1st of September 24. Consequently, we had a short window in which academies were reporting under the previous Academy Trust Handbook, which resulted in the regularity qualification I mentioned earlier. But thankfully that issue is going away for the current financial year. Finally, on this point, I'll just mention that the ESFA has published leasing guidance for Academy Trusts and has recently updated it, but there are 2 different versions that are currently available on their website, so we'll circulate a link just to clarify which is the most recent version. So I hope that's a useful summary of the changes on leases. Next, as promised earlier, Matt is going to discuss investments.
Perfect. Thank you very much, Alan, and good afternoon, everyone. Yeah, so as a brief introduction, I'm Matt Cooper, one of the Associate Directors here at HWB, specialising in academy schools. So today I'm going to do an update on investments. It's an area we've covered at previous forums and also at trustee training before. However, I think although interest rates are continuing to decrease slightly, most recently with the base rate reducing a further 0.25% last Thursday down to 4.5%, they still are at highest levels seen since the financial crash in the late noughties. Therefore, surplus cash can still be used to gain a much needed return on investments by way of interest. Firstly, with regard to risk and reward, this element is vital as it should always be at the forefront of all investment decisions. There are various Academy Trust Handbook requirements, which I'm sure everyone is aware of, including that exposure to investments are tightly controlled, so security of funds takes precedence over revenue maximisation. Another area to keep on top of is market updates. You may have seen that Virgin Money got acquired by Nationwide in October last year, so kind of keeping this in mind will aid with what your decisions are with regards to investments, as potentially mergers will change the risk profile that you and your trustees would assign to certain investments where money is placed. The handbook also makes reference to the Charity Commission's guidance called CC14, which if not already seen would be a useful document to look at. Last updated in August 23, it would be good so that you're aware of what this kind of trustee guidance is all about. In short, it confirms how charities invest so that they can further their charitable aims along with specific legal duties and decision-making processes attached to each of those. In terms of your investment policies, so as I've said before, we've got a template which I'm happy to provide if we haven't provided that to you before. And just with a couple of ideas on this. So firstly, kind of state what the trust's powers are in respect of investments included within its articles, and also to confirm the general objective. So this could be the investment of surplus funds to obtain a superior return when compared to returns received from the main bank account. So thought would need to be taken in terms of what is deemed surplus, for example, ensuring that immediate financial commitments such as payroll and supplier payments are covered. Also, what the trust's risk appetite is, which generally speaking, as I said earlier, with regards to risk and reward, it would be for low risk deposits. And then also authorization limits. So practically speaking, it's kind of, the CFO could invest up to an agreed amount with the CEO or board of trustees having to approve investments above a certain level. It's just really thinking about kind of certain practicalities around it as well. Moving on to the third bullet point now, kind of types of deposits. As it can be a bit of a minefield as there's a lot of options out there. So just a quick summary of kind of the main ones that we've seen across our client base. So firstly, kind of current account, so clearly kind of the trust's main account where its funding is received and is used operationally day to day, likely to have very low interest rates involved. Secondly would be easy access. So there's no notice required on these accounts to make a withdrawal, and then funds are usually back in your main account within a few days. Typically higher interest than current account, but less than the further ones about to mention. Thirdly is notice accounts. So these are typically held for between about 30 and 90 days. These funds can't be withdrawn during a length of deposit without giving the required notice. And importantly on here, interest rates are still variable. And then finally, you've got fixed term deposits. So again, these funds can't be withdrawn until the deposit matures, but here the interest rates are fixed. And these ones tend to be around 3 to 12 months, so a little bit more long term. So a tip on the notice accounts is to be wary of them in an environment where rates are expected to reduce, which could be relevant currently over the next year or so. I think the next meeting of the banks is on 20th of March, where potentially there'll be other base rate changes. And then seeing as the lender can then reduce your rate by giving you 14 days notice, even during the length of that actual notice account, I mean, you may end up with less interest on one of these types of accounts compared to a fixed term. So moving on to some additional benchmarking analysis with regards to investments and interest, in addition to the areas that Alan covered earlier. So what we've done is we've compared the figures across all of our Academy Trust clients and found various themes which will hopefully you'll find useful when taking your own trust investments into account. We had 38 Academy Trust clients for the year ended August 2024, which included 112 schools and over 56,000 pupils. So of these 38 trusts, 45% of them had some form of investment, which could indicate that some trusts do not have any surplus cash to invest, or could simply be that the decision to invest any surplus funds has not yet been started or finalised. I think, like I mentioned earlier, the most important aspect here is that if you are assisting your trustees, so they can make informed decisions as to whether or not investing surplus cash is right for your own trust. On the whole, there's a total of just about 73 million of cash across all 38 clients, and only 21% of this was held in investments. So the total interest received in total was 932,000, as you can see, with 77% of this, 722,000 there, being received from money in investment. So from the investment interest received, that works out at roughly 4.8% interest rate, which is in line with what we've seen over the year on certain deposits. So it's quite interesting as it shows that 77% of the interest is being received across only 21% of the total money held. So like I said, the interest return on the current account predominantly very low as opposed to certain notice accounts and fixed term deposits. Just really theoretically, I mean, if the amount of cash invested was 50% of the total, so call it 36 million, then based on that 4.8%, this could result in an additional 820,000 of interest across the entire client base. So like I said, simply hypothetical, and the amounts being able to be invested will be on an individual basis based upon your own requirements for your trust's cash reserves. Moving on to the next slide, please. Just a few more stats to run through. Perfect. So as you can see, the amount of interest across our client base varies considerably, up to over 100,000 and then down to less than 1,000. You'll see the middle column is all kind of zeros and dashes. It won't be quite nil as we've rounded to the nearest 1,000, so it'll be in the hundreds somewhere. Average interest there of marginally under 25,000. It's also a substantial amount of money that could also go help towards staffing costs or other areas in line with your own trust requirements. Then just got a few rows showing the interest as a proportion of various factors, so per pupil, per school and per teacher, which again shows that the amount of interest which is available could make a real difference. And then finally, in terms of investments as a proportion of total cash held, this again varies quite wildly, so up to as much as about 95% with an average of 16%. So like I've said a few times, the investment decisions will be made in line with your trust's own policies, and therefore kind of as long as the risk is mitigated and cash flow is managed proactively and effectively, there's no reason as to why a proportion of surplus cash cannot be invested for an increased return. So that's everything I wanted to cover with regards to investments and benchmarking on it, etc. today. But of course, like I said, if anyone had any queries, please do get in touch and be happy to help. Before I move on though, just going to do another Slido, so another poll, if you wouldn't mind. So I think just remember, like Michaela mentioned, it's completely anonymous. So please feel free to answer this one. So it's, do you think your trust could be earning more interest by investing surplus cash? So as you can see, oh, that was a quick on the yeses there. So yeah, yes, no, not sure. Just go quiet for a few seconds. Interesting. Yeah, so predominantly on the yeses. So I think that's kind of in line with kind of the stats kind of showed earlier. So it's kind of 21% was invested across 45% of the schools with investment. So yeah, I mean, if this is due to a decision made by the trustees due to specific reasons, that's fine. Obviously, like I said, it's kind of up to you and your own certain circumstances. If it's due to a lack of understanding, perhaps, please, like I said, please do feel free to reach out with me or your relevant director here at HWB, able to guide you in the right direction. Thank you very much. So yeah, I'm now going to pass over to Michaela for an update on procurement limits. Thank you.
Thank you, Matt. So public sector procurement, we covered this topic quite extensively last year in our September forum with Lorraine from Minerva, an external speaker. So this is just really a recap because the new Act comes into force in 2 weeks' time on the 25th of February. So in the box on the slide, I've just put the limits on there to remind you what they are. They change every 2 years. So the next change is due on the 1st of January 26, unless our Labour government decide to change the interval. But, you know, as it stands at the moment, we think it's going to be January 26. Unfortunately, these limits haven't changed in many, many years, not increased with inflation at all, really, and in fact have gone backwards when you look at it in that context. So it's going to become more and more of an issue for your Academy Trust to deal with and trying to keep within the rules. So in the table there, I've set out the sort of common areas that we see in the Academy Trusts and having to go through the public sector tender procurement regime. And the first one there is cleaning that we see quite often and an agency staff, and the limit is 214,000. Now that is the whole limit of the contracts, not just the annual one. And so you can see quite quickly in some of the larger schools or the multi-academy trusts that these limits will be exceeded. So you will have to follow the proper public sector procurement regime. The second line in that box is around works contracts, and basically these are the building projects. So if you're lucky enough to be building or knocking down and rebuilding part of the school, then if your building project is over that 5.3 million, then you will need to follow this process as well. And then the final one is around the light touch regime, and this is mainly will affect you in the catering tendering process, and that is set at 663,000. So again, just limits to be aware of. So Alan has obviously included some of those breaches that we found in last year's audit in his audit report findings slide at the beginning of this presentation. And if I just pick up on the areas that we've seen as being problems, so it tends to be around the fact when you might be very, very busy and all of a sudden you realise that your cleaning or catering contracts are coming up for renewal and you haven't got time to run the proper process. So what tends to happen is you just extend it for a year or two, but that is falls into this and will extend your contract and means that you should have gone through the normal process. And then the other common one is around building projects where, let's say you set out, the tenders all came in, you've agreed it's 5.2 million, and then due to something unforeseen, that building contract is then added on to, and it goes up to say 5.5 million. So you've gone from being compliant when it was 5.2, and now because of the extension, you're non-compliant. So it's just watching out for those little warning flags and sort of considering that at that point in time. And the most common one that we see in the multi-academy trusts is around the use of agency staff. This is a very, very complex area, and we would recommend that you would, speak to Lorraine at Minerva or another procurement expert, because this is a really hard area to decide if you've gone over the limits or not, and then to try and limit your exposure in the most practical way as possible. So rest assured, you won't be the only people that are breaching these limits. We're seeing it at various times across various academies. So what else can you do around the new rules that are coming in on the 25th? There are some ESFA knowledge drop training sessions that you can attend. These are webinars, 45 minutes long. We recommend that anybody gets involved in procurement watches that, and then at least you know what's coming in when, because this new act, all the changes in the rules are being phased in over different dates. So it's not everything changes on the 25th of February, it's coming in over a period of time. So again, you need to be aware of what's happening when. And then finally, I just wanted to mention, if you are in the middle of a tender process at the moment, you are under the old rules, and you can continue on that basis because you've started under the old rules. So you then don't need to worry about the changes that are coming in on the 25th. Okay, so moving on then to the next slide around the timetable. So I just wanted to put this up really as a very brief reminder of the returns that you need to make, and to make sure they're filed and signed off as is necessary. So the next return that is needed is the Schools Resource Management Self-Assessment Tool, and that deadline at the moment is the 14th of March 25. This is one of the returns that does need consultation with your trustees on, and therefore do make sure there is time for them to have a look at it once you have drafted it. Then, as you're aware, the accounts need to be submitted at Companies House 9 months after the year end, so 31st of May. Many of you will have filed these already when they were signed back in December or January, but it's just a final reminder just in case you haven't. And then, of course, do check that you have uploaded the latest set of accounts onto your website, and that you have got now 2 years accounts on there, so 2024 and 2023 year ends. The next listed in the timetable there is the budget forecast return. There hasn't been an agreed date yet, but we're assuming this year it's going to be the 28th of August deadline. So yes, right at the end of the summer holidays. And again, this one needs the trustees sign off. So just to make trustees aware, somebody will be available to look at that once you've got that final draft. Teachers' pension hasn't changed. It will be the 30th of September as always. And then again, the land and building collection tool, 11th of November, we're assuming. Again, that will be confirmed nearer the time. This return that you put in each year has had very little comment from the ESFA over the years. However, we're seeing more and more interest in this, and as auditors we're being directed to look at this in more detail, because the ESFA are aware that there have been some errors, particularly if you're part of a diocese MAT or have a diocese school within your MAT, because the recording that's required on this form isn't the simplest. So we might be looking at those returns in a little bit more detail in future years. Then finally, looking at the audit again, even though we've only just finished this year, the deadline as normal will be the 31st of December for your accounts, audit findings report and the internal scrutiny summary. And then following that, we're assuming 27th of January 26 for the Academy's accounts return. So hopefully that's just a quick run through, some dates to pop into your diary so you don't miss anything. but I'm sure you're all very well aware of those. Nothing has really changed or been brought forward from previous years. So on to the next slide is really just to say, I hope you've enjoyed the session today and you've had a good update. The polls show you that you are not alone in your schools and your multi-academy trusts. I mean, certainly I have clients that are looking at the integrated financial curriculum planning again. They looked at it probably 4 years ago, but they're having to look at it again in order to try and protect those reserves and not go into the deficits that are looming. I'd just like to say, if you'd like to sign up for our monthly Academy newswire, please do drop us an email. We'll make sure you're on the list, and that gives you sort of useful updates of what's happening in the sector. The next date for our forum is the 24th of June, and it will be held in person in Totton this time. It's good quick access from the motorway, plenty of parking, and hopefully means it's easier for academies in Wiltshire, Dorset and Hampshire all to get together and share, which is, I know, what you value at the face-to-face sessions. Then we have another forum planned for the 16th of September, which again will be online. And then finally, we run an annual finance trustee update. And this year we've chosen the date to be the 11th of September. All of these can be booked on our events page on our website or by dropping us an email. So we're quite happy to take your bookings that way as well. And yes, just want to say, if you need any other questions answered, the contacts on the next slide are direct email addresses if you wanted to email any of us. But as we said at the beginning, we will be sending out the slides, the links and the recording end of this week, early next week, so you can then forward them on to anybody in your team. We'd also like to know about any suggestions that you have or what you'd like us to cover in future. In particular in the June session, and there will be a feedback form that you can then pop that on if you wish. So I don't think there are any questions in the chat box as far as I can see. So I think that just leaves me to say thank you to the HWB speakers and to you all for attending, and I hope you have a good week. Thank you. Bye-bye.